In this relatively brief video, we're going to be discussing some principles and actually pitfalls, so mistakes that people often make when performing capital allocation. So making the estimates, for example, needed to compute your NPV and IRR. Let's start with the principles, the things that we should be doing, although often forget to do. First of all, your book states, remember that the cash flows you are considering should be should illustrate their after-tax effects. So absolutely consider the tax consequences of all the decisions of all the inputs that go in. And a very common one is that I often find people forget about or omit is that when you purchase, let's say, non-current assets, obviously that's a negative cash flow, typically at the very beginning, sort of at time zero. Yeah, and then it's supposed to generate benefits from sales, etc. But also, because you are, from an accounting point of view and a tax point of view, charging depreciation on it, depreciation typically it is a tax-deductible expense. So even though depreciation itself is not a cash flow that would enter your computations, because the initial outlay has already done so at the beginning, has been included at the very beginning, the side effect of depreciation being a tax-deductible expense allows you to pay less tax in the future on your taxable income. So that effect should be considered, for example. So let me say here, e.g. depreciation stroke amortization, and that's an important one. It's a sort of big one. The next one is also very important, the fact that we should only consider what are known as incremental cash flows only. And incremental cash flows are the cash flows specifically associated with taking, that decision, that project on. We should ignore definitely sunk costs. These are costs or expenses that have already been incurred, because if you've already spent the money, taking the project on or not is not going to change the fact that cost has been spent. We only care about the stuff that can happen or not from this point in time. And a typical sunk cost is if you've done already some, let's say, market research or feasibility studies, and obviously paid money for them. Don't include that in your further sort of incremental cash flow analysis. It's not an incremental cash flow. We should only focus on those sort of incremental and let's say new cash flows only, good or bad, so those which would not occur without the decision to invest, without the investment. And also, often forgotten, consider the impact on the whole firm, on the sort of broad firm, whole firm, broadly. Because sometimes a project that appears brilliant because it's supposed to generate huge sales benefits, etc., may actually cause you to lose sales, loss of sales from similar products elsewhere in your product line, because people will switch to this one from similar products that you also produce, and this is known as cannibalization in finance, right? Product cannibalization. On the other hand, there may be some positive effects, like taking this project on will lead to savings in other business activity as well. And these incremental additional effects, across the firm should definitely be taken into account. Right, and the final point in the principles, which I think is quite sort of straightforward, well, it's not straightforward, but it's pretty obvious. What matters is cash flow timing. Cash flow timing is crucial because it's not just the size and sign of the cash flows, it's also their timing that hugely impacts your NPV and IRR computations, the two most widely commonly used measures of project appraisal. Okay, what about some of the pitfalls, some of the sort of big mistakes that people make? Well, these are split in your book into cognitive errors and emotional biases. So cognitive errors are sort of the more technical errors that we make. The behavioral biases are more of the sort of emotionally influenced errors that influence our thinking. So first of all, under the cognitive, we've got internal forecasting errors. And this is relatively simple stuff. I mean, we're all prone to making mistakes, but not in the sense of making a stupid numerical mistake or adding things incorrectly. No, it's things like incorrect estimates of costs. We especially have a tendency to underestimate the costs, the support. We're much better at estimating the direct costs, like what's going to be the cost of the raw materials that need to be used, or the cost of a machine. But what about the cost of the time of people needed to support the project? All those admin, IT functions or legal functions that need to maybe work overtime, etc. Much worse at estimating these. Sometimes we get the required rate of return wrong. We often get incorrect the response of competitors. So competitors' responses we don't correctly judge up front. Now this is a good one, ignoring the costs of internal financing. So what we mean by this is that, especially in larger companies, a lot of projects, maybe not those huge ones, but a lot of the sort of medium or smaller sized projects get financed using operating cash flow. So money that's kind of in the company financed with operating cash flows or cash flows from operation, as opposed to being financed via a specific issue of debt or equity. And lots of people assume that because the money is there in the company, it doesn't have a cost associated with it. Well, let me write that this is completely wrong. You shouldn't estimate that the cost of that funding, and therefore the required rate of return, which is a function of the cost, is zero or very low, because that money is not for free. If you're using internal funding, that's funding that could have just as well been used to pay investors a dividend or do a share buyback, so do something for the shareholders. So it should be treated as the same way as you would treat equity funding or equity financing, because in a way it is indirectly equity funding. It could have gone to the shareholders, but shareholders have, I guess, allowed you to keep the money and spend it on an internal project, reinvest that money. So you should treat it equally to equity funding, and you definitely shouldn't associate such financing, internal financing, with a lower R, a lower required rate of return. There are specific questions even on this at the sort of end of the relevant section. But always, remember that project required rate of returns have to be adjusted for project-specific risk. So don't just have one sort of hurdle rate of return for judging projects. Make sure you appropriately adjust it for the risk specific to that given investment. Now, something lots of us are, an error lots of us make, and me included sometimes, is incorrect or inconsistent thinking about inflation. So inflation, either inconsistent treatment of it, or just ignoring it completely in our estimates. As a general rule, the investment analysis can be done in two ways. Analysis may be performed using or in nominal terms. Let me just move this up. Nominal or real terms. So when we do things in nominal terms, we sort of include the effect of inflation, prices going up in our estimates. In real terms, we sort of strip out the effect of inflation. And that's absolutely fine. I mean, that's okay to do, but you must be consistent. Across all the inputs into your computation. It's no good, estimating sales figures in real terms, so without adjusting for inflation, and then doing something different, like nominal approach to costs, because that just isn't comparable. And what is really, really tricky then it's not tricky, but people often forget that you must also not just be consistent across inputs, but also the rate used for discounting, so your required rate of return in your sort of NPV. It should also be either nominal or real, including the effects of inflation, or with inflation stripped out of it. Obviously the choice will depend on how you, on what basis, in what terms you're doing the analysis. Now, the second group of pitfalls falls under the category behavioral biases. And these are also very interesting. First of all, something your book describes as inertia. Inertia being, just sticking to what we've done in the past. And this is especially true at big companies where capital budgets or budgets for capital investments are often just rolled on from the previous year. So they are anchored to prior year investments figures. If we spent amount X in the previous year, let's take that amount, maybe increase it a bit, adjust it for some, positive, a couple of percent up, and let's have that as the next year's investment budget. And that kind of determines how much you can do, and that's completely detached from what opportunities are actually available. I mean, it should be you should start by generating ideas, looking forward, thinking about what makes sense, and then creating your capital budget and prioritizing accordingly, instead of looking back and just rolling things forward. But any of you who have worked in a sort of corporate environment will appreciate that this is often the way people think. The second behavioral bias is basing decisions on accounting measures, especially measures which show profitability, like earnings per share. Well, you see, the problem is that some NPV positive projects, yes, they do deliver added value in the long term, but they may have absolutely negative impact on profitability in the short term. So in the short term, maybe first 1-2 years, they will be a drag on your earnings per share, on your net profit, etc. But obviously later down the line, they should provide a boost. However, such projects may be rejected by managers because they pay too much attention to those short-term profitability measures on which they are often evaluated by the stakeholders, by the investors, the market analysts, etc., which leads them to often reject. Obviously, this shouldn't be happening. You shouldn't be rejecting such positive NPV projects just because of their effect on accounting numbers. But we often fall prey to, we're susceptible to that kind of thinking. Now, the next one is pet projects. Pet projects are those projects which are pushed forward because somebody, typically high up, a senior sort of decision maker, wants that project to go ahead because it's there. They're fixed on this idea of doing this investment or that investment, and such pet projects, because they've got support or backing, or they are sponsored by somebody high up in the organization who we have to listen to, they are often accepted either without sort of rigorous analysis, so the proper analysis that we would subject other projects to, or that analysis is performed but the numbers are put in, but inputs are overly optimistic, just to push that project through, to make sure it goes through. And the backer of that project, the sponsor, is happy, right? Which obviously doesn't lead to necessarily to company value and shareholder value generation. And the final one is failure to consider alternatives. This kind of takes us back to the idea generation phase. We shouldn't stop at, we find something that may potentially work. Let's go with that. Let's count the numbers. You should generate many alternative ideas and see which one is best. But also not just ideas, also considering alternative scenarios. Don't think that only one typically positive outcome or scenario is going to be true. Have alternative scenarios for different eventualities when you do your NPV computation, and weigh them by probabilities, and then see whether the project really makes sense on that kind of scenario probability weighed basis.